Somewhere in Nebraska right now, a family that has never bought a single share of stock is sitting on more wealth than most people with a fully maxed out 401k. Not because they got lucky. Not because they inherited a fortune. Because they own dirt. Actual, boring, unglamorous dirt. And over the last 3 decades, that dirt has quietly out-earned the stock market most Americans have been told is the only serious way to build wealth. That sounds backwards. Wall Street is supposed to be where the smart money goes. Farmland is supposed to be for people who couldn't make it in finance. So why does the math keep going the other way? Here's what we're going to figure out. Why has land that grows soybeans and corn been able to out-earn the S&P 500 with a fraction of the stress? Who's actually been buying it up while nobody was watching? And what are regular investors missing that billionaires clearly aren't? Think of farmland like the tortoise in the old race against the hare. It never sprints. It rarely makes headlines. But while the hare is zigzagging through crashes and rallies, the tortoise just keeps moving forward, and it almost never stops to rest. Keep that image in your head, because we're coming back to it more than once. Before you accept the idea that stocks are simply the best long-term investment available to an American household, ask yourself a question. Best by what measure? Best on average return? Best after you account for how much you'd panic sell during a crash? Best for someone who can stomach watching their portfolio drop 40% and just wait it out? Those are very different questions, and the answers point in very different directions once you actually look at the numbers. Let's start with the plain comparison, because the numbers alone should stop you in your tracks. Looking at data stretching from the early 1990s through 2020, farmland delivered average annual returns in the range of 10 to 11%, according to figures tracked by the National Council of Real Estate Investment Fiduciaries. The S&P 500 over that same broad window averaged closer to 8%. That's not a small gap when you compound it over 30 years. But the return isn't even the most interesting part. It's how it got there. Stocks are volatile. That's not an insult, it's just physics. The S&P 500's year-to-year swings have historically run around 17%. Farmland swings, by the same measurements, have been closer to 7%, roughly in line with high-quality bonds, not equities. Picture 2 guys driving from New York to Los Angeles. One of them is white-knuckling through a car that swerves violently every few miles, occasionally spinning out entirely before getting back on the road. The other is cruising in a straight line at a slower, steadier pace. They can end up at the same destination. Only one of them arrives without a stomach ulcer. Now here's where it gets genuinely strange. During the 2 worst modern stock market meltdowns, the dot-com crash and the 2008 financial crisis, farmland didn't just survive, it kept climbing. Estimates from industry trackers suggest that through the 2008 crisis, while the S&P 500 was losing roughly 37% of its value, farmland prices were still posting gains. That's not farmland being immune to economic pain. It's farmland responding to a completely different set of forces, food demand, not investor sentiment. But don't let that convince you land is some risk-free money machine, because history already ran that experiment, and it ended badly. Rewind to the late 1970s. American farmers were riding a genuine boom. Grain exports to the Soviet Union were surging, commodity prices were climbing, and the federal government was practically begging farmers to expand. So they did, buying more acreage, financing new equipment, taking on debt at a scale that felt manageable at the time. Then the Federal Reserve slammed interest rates upward to fight inflation, rates that at points climbed above 20%. Export markets collapsed. Commodity prices crashed. And the land that farmers had borrowed against, the collateral underpinning all that debt, lost an estimated 50 to 60% of its value across parts of the Midwest between 1981 and 1986. Total farm debt nationally roughly doubled in that stretch. An estimated 1 out of every 3 farmers in states like Iowa ended up in serious financial trouble, and hundreds of thousands of farms disappeared entirely by the end of the decade. That's the part the buy land, get rich crowd conveniently leaves out of the story. Farmland's advantage isn't that it can't crash. It's that it crashes for different reasons, on a different clock, and it's historically taken a genuinely reckless debt bubble, not a bad earnings quarter or a Fed rate hike, to actually break it. So who figured out how to ride the tortoise without stepping in front of it? This is where the story gets a little uncomfortable, because it isn't just farming families anymore. Bill Gates has spent the last several years quietly assembling the largest private farmland portfolio in the United States, reported at roughly 250,000 to 275,000 acres spread across close to 20 states, from Louisiana to Nebraska to eastern Washington. When he was asked about it directly, he brushed off the conspiracy theories, explaining that his holding amounts to a small fraction of total U.S. farmland and that the investment decisions are handled by a professional team, not some grand scheme. Other billionaires and family investment vehicles, names tied to major agricultural brands, media empires, and private equity, show up on the same ownership lists. These aren't people chasing a hot tip. They're allocators with access to every asset class on Earth, and a meaningful chunk of them have chosen dirt. Here's why that matters more than it sounds. Roughly 97% of American farms are still family-owned, which means the market for buying serious farmland isn't liquid or easy to access the way the stock market is. There's no app where you tap a button and own a slice of Iowa corn country the way you'd buy a share of Apple. Meanwhile, the total supply of usable farmland in the U.S. keeps shrinking every year, eaten up by suburban sprawl, solar development, and industrial expansion. You've got a shrinking supply of something everyone still fundamentally needs, food, being quietly bought up by people who already have more capital than they know what to do with. That's not a coincidence. That's just what scarcity does to price over time. And there's a psychological layer here that explains why most everyday investors miss this entirely. Stocks are exciting. You can check the price on your phone 40 times a day, watch it jump or crater in real time, feel the dopamine hit or the dread. Farmland gives you none of that. There's no ticker. No CNBC segment. No red or green number flashing at you before breakfast. Behavioral economists have long pointed to something called loss aversion, the tendency to feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. A volatile stock portfolio triggers that feeling constantly, and it's exactly what leads regular investors to sell low during a panic and buy high during euphoria, quietly wrecking their own long-term returns. Farmland, by being slow and mostly invisible, sidesteps that trap almost by accident. You can't panic sell an asset you're not staring at every day. There's a modern echo of the 1980s crisis worth noting too. Around 2019, U.S. farm debt climbed to roughly $409 billion, a level Agriculture Department officials at the time explicitly compared to the debt burden right before the 1980s collapse. It was driven by falling commodity prices, trade disputes, and years of thin margins for actual working farmers, the people growing the crops, not the investors who quietly bought land nearby. That's an important distinction the "farmers becoming millionaires" headline tends to blur. The families getting rich from farmland right now are disproportionately the ones who already owned significant acreage decades ago and watched its value compound, or large-scale operations and investment vehicles buying at scale. Plenty of smaller, working farmers are simultaneously carrying real financial strain. Wealth from land ownership and income from farming a small operation are two very different stories that happen to share the same word. So let's go back to the question we opened with. Why has farmland been able to quietly out-earn the market most people are told to trust completely? It comes down to the tortoise and hare pattern we started with. The stock market moves on sentiment, news cycles, quarterly earnings, and the herd behavior of millions of traders reacting to all of it in real time. Farmland moves on something slower and more stubborn: how many people need to eat, and how much usable land exists to grow their food. That difference in what drives the price is exactly why the two assets have historically been only loosely connected to each other, sometimes barely moving in sync at all. It's also exactly why farmland can't be timed or hyped the way a stock can. There's no viral farmland stock to chase, no meme version of a Nebraska cornfield. That absence of excitement is, ironically, the whole advantage. None of this means everyone should go liquidate their index funds and buy acreage in Kansas. Land is illiquid, it requires real capital to get into, and as the 1980s proved, it is not immune to collapse when debt gets reckless enough. But the pattern is worth sitting with. The people already holding the most capital in the world didn't chase the exciting, fast-moving asset. They quietly bought the slow one. Maybe the lesson isn't about farmland specifically. Maybe it's that the most reliable way to build wealth has never been about finding the loudest opportunity in the room. It's about finding the one nobody's paying attention to, and being patient enough to let it work. If this is the kind of pattern you want to get better at spotting, that's really the whole point of a channel like this.